Chapter 7 Incident Management Certificate Examination in Prevention of Cybercrimes and Fraud Management. Subscribe, like, and share. Incident Management. Incident management is defined as the process of developing and maintaining the capability to manage incidents within a bank so that exposure is contained and recovery achieved within a specified time objective. Incidents can include the misuse of computing assets, information disclosure, or events that threaten the continuance of business processes. 2. Major activities that need to be considered as part of the incident management framework include a. Developing and implementing processes for preventing, detecting, analyzing and responding to information security incidents. B. Establishing escalation and communication processes and lines of authority. C. Developing plans to respond to undocumented information security incidents. D. Establishing the capability to investigate information security incidents through various modes like forensics, evidence collection and preservation, log analysis, interviewing, etc. E. Developing a process to communicate with internal parties and external organizations, for example, regulator, media, law enforcement, customers. F. Integrating information security incident response plans with the organization's disaster recovery and business continuity plan. G. Organizing, training and equipping teams to respond to information security incidents. H. Periodically testing and refining information security incident response plans. I. Conducting post-mortem analysis and reviews to identify causes of information security incidents, developing corrective actions and reassessing risk, and adjusting controls suitably to reduce the related risks in the future. 3. Common incident types include, but not limited to, outages/degradation of services due to hardware, software or capacity issues, unauthorized access to systems, identity theft, data leakage/loss, malicious software and hardware, failed backup processes, denial of service attacks and data integrity issues. 4. A bank needs to have clear accountability and communication strategies to limit the impact of information security incidents through defined mechanisms for escalation and reporting to the board and senior management and customer communication, where appropriate. Incident management strategies would also typically assist in compliance with regulatory requirements. Institutions would also need to proactively notify CERT/IIBF regarding cybersecurity incidents. V. All security incidents or violations of security policies should be brought to the notice of the CISO. Electronic cards, credit cards and debit cards. As mentioned above, India is one of the fastest growing countries in the plastic money segment. Already there are 130 million cards in circulation, which is likely to increase at a very fast pace due to rampant consumerism. India's card market has been recording a growth rate of 30% in the last 5 years. Card payments form an integral part of payments in India because customers make many payments on their card, paying their bills, transferring funds and shopping. Ever since debit cards entered India, in 1998 they have been growing in number and today they consist of nearly 3/4 of the total number of cards in circulation. Credit cards have shown a relatively slower growth even though they entered the market 1 decade before debit cards. Only in the last 5 years has there been an impressive growth in the number of credit cards by 74.3% between 2004 and 2008. It is expected to grow at a rate of about 60% considering levels of employment and disposable income. Majority of credit card purchases come from expenses on jewelry, dining and shopping. Another recent innovation in the field of plastic money is co-branded credit cards, which combine many services into one card where banks and other retail stores, airlines, telecom companies enter into business partnerships. This increases the utility of these cards and hence they are used not only in ATMs but also at point of sale, POS, terminals and while making payments on the net. Prepaid payment instruments. Eligibility. Banks who comply with the eligibility criteria would be permitted to issue all categories of prepaid payment instruments. Non-banking financial companies, NBFCs, and other persons would be permitted to issue only semi-closed system payment instruments. Capital requirements. Banks and non-banking financial companies which comply with the capital adequacy requirements prescribed by Reserve Bank of India from time to time, shall be permitted to issue prepaid payment instruments. All other persons shall have a minimum paid-up capital of 100 lakh rupees and positive net owned funds. Safeguards against money laundering, KYC/AML/CFT, provisions. The maximum value of any prepaid payment instruments, where specific limits have not been prescribed including the amount transferred, shall not exceed Rs 100,000/. Deployment of money collected. Non-bank persons issuing payment instruments are required to maintain their outstanding balance in an escrow account with any scheduled commercial bank subject to the following conditions. The amount so maintained shall be used only for making payments to the participating merchant establishments. No interest is payable by the bank on such balances. Validity. All prepaid payment instruments issued in the country shall have a minimum validity period of 6 months from the date of activation/issuance to the holder. The outstanding balance against any payment instrument shall not be forfeited unless the holder is cautioned at least 15 days in advance as regards the expiry of the validity of the payment instrument. RuPay debit cards. It is a domestic card payment network established by National Payment Corporation of India, NPCI, having more than 100 banks in India as members with its ATM network spread across the country. These cards can be used at all ATMs of NPCI network and POS terminals and e-com transactions, Internet-enabled for RuPay acquiring. The various types of RuPay debit cards are as under. Card type meant for RuPay Kisan farmers availing agriculture production loans, crop loans. RuPay Aadhaar beneficiaries of Electronic Benefit Transfer, EBT, scheme. RuPay debit beneficiaries under financial inclusion schemes. It provides accidental insurance cover up to 1 lakh without any charge to the customer. To avail this benefit, the card must be used minimum once in 90 days. The existing identification modes used in new delivery channels has a major drawback as it recognizes the PIN but not the person. Sometimes, it leads to impersonation and may cause financial loss. To overcome the problem, biometric technologies such as fingerprint recognition, face recognition, voice authentication, hand geometry, retinal scanning, iris scanning and signature verification have come into force. Whenever the user access to delivery channel, it verifies with the server and deliver the service if found correct. Recently, NPCI introduced 2 variants of cards viz. RuPay Platinum and RuPay Select with value-added features at competitive interchange fee compared to Visa/Master. Data security. Banks need to define and implement procedures to ensure the integrity and consistency of all data stored in electronic form, such as databases, data warehouses and data archives. 2. A data security theory seeks to establish uniform risk-based requirements for the protection of data elements. To ensure that the protection is uniform within and outside of the institution, tools such as data classifications and protection profiles can be used, as indicated earlier in the chapter. 3. Data classification and protection profiles are complex to implement when the network or storage is viewed as a utility. Because of that complexity, some institutions treat all information at that level as if it were of the highest sensitivity and implement encryption as a protective measure. The complexity in implementing data classification in other layers or in other aspects of an institution's operation may result in other risk mitigation procedures being used. Adequacy is a function of the extent of risk mitigation, and not the procedure or tool used to mitigate risk. 4. Policies regarding media handling, disposal, and transit should be implemented to enable the use of protection profiles and otherwise mitigate risks to data. If protection profiles are not used, the policies should accomplish the same goal as protection profiles, which is to deliver the same degree of residual risk without regard to whether the information is in transit or storage, who is directly controlling the data, or where the storage may be. There should be secure storage of media. Controls could include physical and environmental controls such as fire and flood protection, limiting access by means like physical locks, keypad, passwords, biometrics, etc., labeling, and logged access. Management should establish access controls to limit access to media, while ensuring that all employees have authorization to access the minimum data required to perform their responsibilities. More sensitive information such as system documentation, application source code, and production transaction data should have more extensive controls to guard against alteration, for example, integrity checkers, cryptographic hashes. Furthermore, policies should minimize the distribution of sensitive information, including printouts that contain the information. Periodically, the security staff, audit staff, and data owners should review authorization levels and distribution lists to ensure they remain appropriate and current. Why? The storage of data in portable devices, such as laptops and PDAs, poses unique problems. Mitigation of those risks typically involves encryption of sensitive data, host-provided access controls, etc. 7. Banks need appropriate disposal procedures for both electronic and paper-based media. Contracts with third-party disposal firms should address acceptable disposal procedures. For computer media, data frequently remains on media after erasure. Since that data can be recovered, additional disposal techniques should be applied to sensitive data like physical destruction, overwriting data, degaussing, etc. 8. Banks should maintain the security of media while in transit or when shared with third parties. Policies should include contractual requirements that incorporate necessary risk-based controls, restrictions on the carriers used, and procedures to verify the identity of couriers. 9. Banks should encrypt customer account and transaction data which is transmitted, transported, delivered or couriered to external parties or other locations, taking into account all intermediate junctures and transit points from source to destination. A few other aspects that also needs to be considered include appropriate blocking, filtering and monitoring of electronic mechanisms like email and printing, and monitoring for unauthorized software and hardware like password cracking software, keyloggers, wireless access points, etc. 11. Concerns over the need to better control and protect sensitive information have given rise to a new set of solutions aimed at increasing an enterprise's ability to protect its information assets. These solutions vary in their capabilities and methodologies, but collectively they have been placed in a category known as Data Leak Prevention, DLP. It provides a comprehensive approach covering people, processes, and systems that identify, monitor, and protect data in use, for example, endpoint actions, data in motion, for example, network actions, and data at rest, for example, data storage, through deep content inspection and with a centralized management framework. Most DLP solutions include a suite of technologies that facilitate three key objectives: locate and catalog sensitive information stored throughout the enterprise, monitor and control the movement of sensitive information across enterprise networks, monitor and control the movement of sensitive information on end-user systems. Banks may consider such solutions, if required, after assessing their potential to improve data security.